Part 1, Defining Technical Analysis. Chapter 1, Opening the Technical Analysis Toolbox. Technical analysis is the study of how securities prices behave and how to exploit that information to make money while avoiding losses. That means it is study uh, it is study, but purpose of that study is to understand how securities prices behave. That means to predict future prices or to predict future conditions. That is the main uh, point or use of this study. Then be careful not to fall into the semantic trap of thinking that a trader is a wild-eyed speculator while an investor is a respectable guy in a pinstripe suit. That means don't fall into trap of thinking as a investor is a genuine person, or a investor is a, what can I say, he is a more reliable person. Don't fall into that trap. There is no such thing like a trader is more reliable or investor is more reliable. Both are professionals, but both are doing their work. You can use technical analysis to spot a high probability trade and execute purchase and sale in 1 hour. So you can also use technical analysis for 1 hour, for more than 1 hour, like 1 day, 2 days. So technical analysis can be used for those purpose. Then choosing a trading style. Trading styles are a function of holding period. That means function means f of x. That means uh, it changes with holding period. That means for holding period, very less holding period, the trader is called trading style is called scalping for very less period. Then for trading during day and selling selling on that day only, that trading is called as intraday trading. Or for trading on 1 hour candles, that can be called as swing trading, etc. So trading styles are a function of holding period. Then preventing and controlling losses is more important than outright profit seeking to practically every trader you meet. That means preventing and controlling losses means to avoid loss, to stop your losses is more important than making profit in trading. To embrace technical analysis is to embrace a way of thinking that's always sensitive to risk. That means technical analysis is a what can we say, subject which deals with risk. So we have to deal with risk always. Then to make profits consistently, it requires that you not only identify the trading opportunity but also manage the risk of the trade over a lifetime of your ownership of security. To make profit, we have to make profit consistently. For that, it requires not only to identify the trading opportunity but also to manage risk of the trade over lifetime. That means you have to be consistent for consistently making profits with your strategy. Truth about buy and hold. It is a philosophy that says buy and hold is a philosophy that says most equities are best left unattended for long periods of time. That means buying and holding, like fundamental analysis, like buying below intrinsic value and then holding it for a longer period. So that is the basic philosophy of technical of buy and hold buy and hold approach. That is basic philosophy. Then these equities rise more or less in sync with overall economy, saving your transaction cost and taxes. That means these equities in buy and hold kind of system, you do spend a lot less money in transaction costs. That means buying and selling transactions are very less, so the as compared to technical analysis, so uh, it cuts transaction loss. And these equities rise or more or less in sync with the overall economy. That means you just buy and hold and wait for rising of that script. That means they rise with in sync with overall economy. That means if overall economy is rising, then these equities will also rise. Then one reason to distrust buy and hold is that over really long periods returns are not very good at all. That means uh, as compared to technical traders, buy and hold strategy gives you a very less results. That means very less profits. So this is one reason to distrust buy and hold approach. To buy and hold securities for long period of time is a well documented path to accumulating capital, but only if you got in at right time. That means you can generate capital, you can accumulate a good amount of capital, but only if you are entering at right time. That means when market is crashed or a price is low, if you are entering at that point only, then it is only profitable, then it is profitable only. Otherwise it is not that much profitable as a technical approach. So this is a second reason for distrusting buy and hold approach. Trend is your friend. Trend is a discernible directional bias in a price upward, downward, or sideways. That means it is a change in direction of price. So it can be upward, it can be downward, or it can be sideways. That means it is going nowhere, it is moving in a linear fashion or in a rectangular area. You can consider sideways a trend because when you widen time frame, you see sideways moves in a transition phase from up to down or down to up. That means sideways trend is not a trend, but it can be considered as a trend because it can be used to make money also. Because when you widen time frame, that means from 1 hour, if you widen time frame, that means you see 1 minute candle. That means when you zoom in chart, you can see the trend is actually moving up and down. So sideways trend is also a trend. Decluttering your mind. Prices incorporate all known information including assumptions. They change as new information is available. That means prices include all informations, like including assumptions. That means people also assume that a certain script will increase or certain stock will increase, and also some news involves. So it involves a lot of information. Then charting your path. The figure shows uptrend, downtrend, and key reversal, which is shown here. So this is price, so it was moving sideways at first here in this area, then it moved downwards. Here it is moving downward, then a point came called key reversal. So after this point, prices move upward. So we can draw a line which is from here to here, it is downtrend. then this was a key reversal. It was a big candle as compared to other candles. It was a key reversal. Then prices went upward. That means we are drawing another line here. So prices are going into uptrend. Trendedness, to say something is on trend is to say it moves in a specific direction. That means something is trending, that means it is moving in a specific direction. That means, for example, we'll see first example, use of social media like Facebook and Twitter. So this is a trend nowadays. Use of social media is also a trend nowadays. Then families are having fewer children. That means families are considering to have a few children as compared to previous years. That means this is also a trend. And differences between trendliness and trendiness and trendedness. So, what is trendiness? Trendiness implies a fashion or fad that can be blown away. That means we know that it is a fad. That means it has no meaning. For example, wearing certain clothes, that can be a fad and it can be blown away when another trend appears in market. Then trendedness refers to a measurable directional bias. That means it is a measured change in direction over a long period of time. That is trendedness. It is a more serious phenomenon than trendiness. Trendedness is more serious phenomenon than trendiness. Then charting refers to reading supply and demand into bars and patterns. That means making a candle of 1 hour, that means high low, that is charting. So it is graphical representation of price by plotting bars and patterns, by plotting candles, bar charts, candle charts, and finding patterns from it. Then trend following, the very first question to ask when you look at any chart is this price trending? So first question that you ask after looking chart is this price trending? That means is market is trending, or is price going uptrend, upwards or downwards or sideways? So that is first question that we need to ask to ourselves. Technical analysis is not confined to just math based techniques as some people think. Due to rapid evolve in computers and softwares, technical analysis has become more over a math oriented program or math oriented subject, but it is not so. Numbers can lie all the time in price analysis. That means numbers can be misleading. That means you cannot predict price by numbers only. You can have a textbook perfect trend with 10 confirming indicator and it can still run into a brick wall. That means you can apply all the indicators which are confirming and it can still go against your predictions. A really bad news that trashes price of security overnight. That means for example, a really bad news occurs like a 9/11 attack or a hurricane, etc. So a really bad news that trashes price of security overnight, such situations occur. Do not forget, behind numbers there are human beings who often behave irrationally. Do not forget that uh, there are human beings who are moving markets behind those numbers. So you don't have to rely on numbers that much. So it is not exactly a mathematically based field.